All right. Hey, folks. Welcome back to the channel. This is Jason, host of Fighting Words Financial. Today, it's been a busy, busy weekend for me. Kind of tired today. I'm basically running on coffee, some good Colombian coffee, by the way. But wanted to cover what's going on in markets today. And in particular, let's take a look at Palantir's earnings. This is a company that I don't really make a ton of videos on, but it does come up on my live streams pretty often. And I've shared my opinion, and we'll go over what their actual earnings results say. And if we're on long enough for Upstart's results to come out, we'll take a look at those too. Upstart's results, I expect, are going to look pretty bad this quarter. I am looking at this as an investment opportunity, largely because I already know what's coming for Upstart in terms of some one-time costs and write-downs on the loans that they had on their books, and they converted into cash. So they don't typically keep loans on the books. They typically sell those portfolios of loans. Because of the rapidly changing interest rate environment, they got caught out a little bit, and it looks like they had to sell one of those books of loans at a loss. So markets today, as the numbers are trickling in, relatively flat. I got the Dow Jones up 27, the NASDAQ down 28, the S&P down 4, and the Russell 2000 up 2. So nothing moving much out of that 1.1% range, with most of the indices between 0.1 and 0.2%. So not a lot of movement for the market as a whole. And we saw technology, of course, leading the way in terms of losses, down about 1.26%. A lot going on there. But let me know if you guys have any specific questions. Otherwise, I'm going to talk about some of the big news. Nvidia stinks today because they released some preliminary earnings, right? So the chip manufacturer shared preliminary financial results. Sometimes these come out a month before the actual financial results. It's basically just a warning. So Nvidia is expecting revenue to be about 6.7 billion, well below guidance and estimates calling for 8.1 billion. The miss is primarily due to weaker than forecast gaming revenue, which will come in about 33% lower year over year. So if you guys have been paying attention to Nvidia as the years have gone by, then you got to recognize that they have been more and more diversifying their income sources. So they say that their gaming product sell-through projections declined significantly as the quarter progressed. And as we expect, macroeconomic conditions affecting all sell-through to continue. We took actions with our gaming partners to adjust channel prices and inventory. So gross margins is expected to come in at 46.1%, down from the previous guidance of 67.1%. That's actually really bad. The company still believes that long-term gross margin profile is intact, as it has slowed operating expense growth. The silver lining, and this is what I'm talking about, diversifying lines of business. Nvidia, along with a number of other companies in this space, are really sort of diversifying the ways that they make business. They're no longer dependent solely on GPU sales. The silver lining is going to come from the company's data center, which saw record revenue of 3.81 billion for the quarter, up 61% from the year before. That said, the company acknowledged it was short of expectations because of supply chain disruptions. So they're going to report their final earnings on August 24th. I don't expect a giant variance from these right here. So shares were down 7.9%. I think they're down about 12% for the day. I just bought like 2 shares a few minutes ago, like literally just a few minutes ago. That's all the free cash that I had in that account, but I wanted to buy that while they're down. I own Nvidia. I don't do options trading on Nvidia. Basically, every option strategy I've had with Nvidia has blown up in my face, largely because it is seriously, seriously volatile. So, let me know what you guys are thinking in the comments below here. Wall Street analysts already slashed their projections on Nvidia heading into earnings as the demand for graphics cards and personal computers has weakened. Barron's has also cautioned investors about the company's fundamentals in April, citing unsustainable prices and exposure to cryptocurrency mining. So there's a lot less exposure to cryptocurrency mining than there has been in the past. And that really started almost 2 years ago. So I'm not sure. I had to go back and read that article, see what they were saying. So Piper Sandler, which rated Nvidia at overrated, said they weren't surprised to see the lower gaming revenue, but were surprised by the size of the miss. And I got to admit, I am surprised by the size of the miss. I looked at this today as a buying opportunity. My only regret is that I could only afford to pick up a couple of shares. But anytime shares are under $200 at this point, I'm looking to acquire. And I even snapped up a few at like 158 a couple of weeks back. So that was fairly nice. So a couple of other things. So Intel, Micron, and three other stocks with direct exposure to Taiwan. And this is an article on Barron's that talks about these companies. Of course, it's going into all eyes being on Taiwan as China launches live fire military drills. This is just political posturing here. I don't believe that there's going to be. Yes. Let me see. Actually, let me check Upstart right now. I have the website up. All I have is the preliminary results that were released about a month ago. And so I don't think they've updated as of yet. Yeah, so just they're in the conference call. The conference call starts in 30 minutes. Oh, no, this is preliminary results. Sorry. So the preliminary results from a month ago, as you recall, with Upstart were kind of negative. And look, it's going to be, I think, you should prepare yourself for them reporting, of course, after hours. This could be really bad. Now, let me tell you guys, these are not the actual results that will be reported here in a little bit. These are preliminary results that came out on July 7th, 2022, talking about what they expected. So they expected that revenue is going to be between or approximately 228 million after they previously guided to 295 to 305 million. That's a huge drop, right? That's a huge miss by any margin. So contribution margin is expected to be approximately 40%, 47%, previously guided at 45%. So the net income or loss is expected to be in the range of negative 31 to 27 million, meaning they're losing 31 to 27 million a quarter, as opposed to being guided before at a net loss of possibly anywhere from 4 million to breaking even. So really, really huge in terms of their preliminary results. So this is what they published a month ago, saying that this is what they expected coming out today. So they're talking about how inflation fear and recession fears have driven up interest rates and put banks and capital markets on cautious footing, meaning that not as many people are asking them to sell these loan portfolios at this point. And a lot of folks in the secondary market have probably lost their appetite for some of these lower interest loan portfolios, meaning that the discounts on getting rid of those were probably fairly steep. And this is kind of where they let you in here. Second in Q2, we took action to convert loans on our balance sheet. And let's remember, Upstart does not like to have loans on their balance sheet, doesn't want to carry them on their balance sheet. They mostly make their money through loan originations, and then they sell the loans. So they took action to convert the loans on the balance sheet into cash, which, given the quickly increasing rate environment, negatively impacted our revenue, meaning they had to sell those off at a discount, and they ended up losing money. So during the second quarter, we improved our unit economics and oriented ourselves towards positive cash flow, even at lower loan origination volumes, which I'll need to get into what exactly they mean by that. That seems to be really carefully worded there. So I want to see what their so that'd be something that seems to be really carefully worded, and I'd want to take a second look at that. So with low fixed cost base, we expect to continue adding to our almost 800 million unrestricted cash balance as we continue repurchasing Upstart shares as it makes sense. So they are still instituting share buybacks. And finally, despite limiting hiring in critical areas, we can continue to invest in our models and products and are confident that Upstart will emerge from this cycle as a stronger company. So, so I'm going to wait here for just a bit until I think that we probably won't see these results come out until 1:30 when they start the conference call. So, so back to here. Back to this article right here where Intel, Micron, and three other stocks with direct exposure to Taiwan. They're talking about that. The point of this article is saying that these are companies that buy and sell with Taiwan, and they could be hurt. And let's talk about what they're talking about. So these stocks have direct exposure to Taiwan and could be vulnerable to further escalation. So Teradyne, Applied Materials, Lam Research, Micron, and Intel. And they're talking about the percentage of sales that go to Taiwan. So Teradyne is 38%. Intel is down here at 15%. So surprisingly, I'm not sure why, but what they didn't also cover in this article is what would happen if China blockaded the island and cut off the supply of semiconductor chips to the United States. That would be really disastrous. And I think that no one really wants to even consider a step like that. So this trade wouldn't be restricted in only this one direction where these companies wouldn't be able to sell their products to Taiwan. The reverse would also be true as well. And it would put a lot of pressure on the entire economy of the United States if that were to happen. So that's a definite point of vulnerability for us. and Taiwan. But this article, like I said, only goes halfway, and a lot of the articles talking about sort of what's going on with the China crisis are only going halfway as well. So before we start talking more about Upstart's results, we're going to talk a little bit about Palantir's results, and we're going to talk about the good, the bad, and the ugly in here. Now, I've seen a couple of YouTubers who are, some of them were formerly really high on Palantir. Some of them still are really high on Palantir, but they do recognize that these are bad quarterly results. So I have not been high on Palantir for the last 2 years, just because I've worked in this defense space off and on for 20 years or so. And I understand the world of procuring government contracts probably better than most YouTubers do. And I've been less excited about Palantir's expansion in the government space than I have been in the commercial space. And I think that these really kind of poor results are probably not as bad as everyone thinks. And the company is merely acting a little bit more like every other government contractor. So I expect to see, so their growth in government contracting has slowed. It hasn't gone in reverse, but it is definitely slowed to right around industry average, because there are natural limits and for a couple of different reasons as to how big their business can actually get. Number one, there are a number of agencies that don't actually like working with them because of some of the things that they've refused to deny in the past, and some of their use of their mystique. Number two, there's also the government fear of over-reliance on a single partner. So you're never going to have like complete dominance in any field of business here. Number three, they claim that they're the only people that do what they do. That is just simply not true. All right. And I heard Alex Karp say this on the call earlier, and that is just not true at all. Not in any dimension, not in the private sector space, not in the public sector space. They have lots of competition in all areas. So maybe not in a single product, but they have competition. And that's actually super important as well. Like I said, the government does not want to have over reliance on any single provider for anything. And even if Palantir can do everything and more than another product does, sometimes that other product wins. And let's also remember that it isn't always the best product that wins anyway. So, my expectations of Palantir's performance have always been tempered by a few things. Number one, I'm very familiar with this government contracting space. But number two, it has always bothered me that the primary reason for Palantir to go public was never to expand their business, but it was to reward insiders. In fact, that is something that Alex Karp himself publicly stated way back in 2019, that's why they were talking about going public, is to reward the people that have been working there for so long. And I know a lot of folks talk about their stock-based compensation being so high. A lot of that has to do with their location and the type of business that they're in and the type of people that they want to attract. That's not going to stop, right? You can't get people that talented to work just for money. They need to have skin in the game too. So every major software as a service company like this is offering stock options. There's lots of stock-based compensation. And now that Palantir is adding a sales force, right? They're adding this business-to-business sales force. You're probably going to see that stock-based compensation grow. It's only declined now compared to 2021 because the price of the stock is less than half of what it was this time last year. That's the only reason that stock-based compensation has actually declined as a percentage of their revenues. It's going to climb, especially as they build this business-to-business sales team. I think they figured out that business-to-business sales weren't going to come by word of mouth. They were going to have to advertise, they were going to have to market, and they were going to have to pay people to pound the pavement, make phone calls, make connections, fancy dinners, all of that stuff. So because that's just the nature of the business. So let's talk about Palantir's business here. I watched a couple of videos this morning that other YouTubers put out on these, and like I said, they're a little bit more alarmist than I'm going to be on this, largely because I understand the government half of their business. So revenue grew to 473 million in Q2 of 22 is the major points. Customer account increased to 304, up from 169 a year ago. And our U.S. business generated more than $1 billion in revenue on a TTM basis, 42% growth over the prior period. So very interestingly, another YouTuber named Sasha pointed this out, that U.S. business has never been a metric that they've used. They've always broken it down a little bit differently, right? They used to break it down by a couple of different sectors, and the commercial sector revenue grew by 120% year over year. That's actually really good, but we'll get into why that may not be as good as it seems. Okay, so very interesting. When it has to work, there's only Palantir. It's great. It goes over all the different things that they do here. Supporting mission and outcomes for Ukraine, empowering refugee relief, powering public safety, power shutoff programs to mitigate wildfire risks, combating the rise of ISIS external operations. All kinds of things going on here. And here is some of the things that are going on. In their newer products, Palantir Healthcare across commercial and government sectors generated $153 million in revenue for the first half of 2022, up from $42 million in the first half of 2020. Interesting that they skipped over 2021 to make that look really nice, representing a growth rate of 267%, not year over year, but over the last 2 years. Okay. So interesting that they did that. This is one of the most interesting things on here, which is total addressable market expansion. And for each of the three products, Gotham, Foundry, and Apollo, where it starts off back in 2013. You guys probably can't read this, but it was human, which is like human intelligence within the intelligence community, means that things that people were gathering, right? Then they expanded in 2014 to all sources within the intelligence community. And that would be like also signal intelligence and that sort of thing, phone calls, all that stuff. Defense intelligence expanding. And in 2016, they bring in law enforcement, justice, cybersecurity, and fraud. Again, more expansion into intelligence operations. But at this point, when I'm looking at their kind of their purview in the Gotham sector here, they've pretty much gotten everywhere they're going to go as far as expanding into different types of businesses that are out there, and meaning different areas of what Gotham covers. And so we're really looking at growth in Foundry over here being more important at this point. This also has both public sector applications and private sector applications, especially when it comes to supply chain management, predictions, when it comes to modeling, and really just making linkages between data sources, basically being able to create insights from data from vast and disparate data sources that aren't necessarily connected, right? So you're really going to see your growth from this point on in Foundry. And we're probably looking at the adoption of Gotham. Other than in law enforcement, it's probably going to slow down fairly significantly, meaning if I see greater than 15% growth in this particular product overall, I'd be surprised. And of course, Apollo is something new here, bringing Palantir software as a service to any environment. And the control center, their software supply chain, all that stuff is done through Apollo. So and they list a bunch of new products here. Before we get into the real data or the real stuff that we're looking at here, and which is the results. All right. So financials, total U.S. revenue growth. Like I said, for some reason, they did total U.S. revenue growth when they used to break this down a little bit differently in past quarters, but it's up 45% year over year, which looks pretty good, right? So, and of course, they went over the $1 billion threshold for the first time for the period ending in June 30th, which is that for the first half of the year. So, so total government revenue growth is at 13%. This actually represents a significant decline from just 2 to 3 years ago. I want to say that their government revenue growth was in the 30% range, 25% range before that, and it's declined quarter by quarter ever since. And they've missed earnings estimates for and revenue estimates for the last 3 quarters anyway. But actually, this number isn't all that concerning to me, and it doesn't surprise me that much. Like I said, growth in that government sector. Number one, your government customer is always going to be there. The additional business you can do with existing customers, meaning different departments within the governments, that those opportunities are always going to be there. But the fact that it's slowing down doesn't surprise me. Like I said, for all of those vast variety of reasons, you have a lot of entrenched interests when it comes to adoption of any products within government services that can sometimes get in the way of you really doing well, right? Total commercial revenue growth here looks really good. Q2 to 2021 to Q2 2022, 46% growth looks absolutely fantastic. We're looking at 46% growth. I think that looks fairly good. Not wonderful, but fairly good. So then the net dollar retention of 119% is not necessarily great. I think for software as a service as an industry, it should be about at least 130, 135%. When you're looking at a company like Snowflake, it's close to like 175, 180, meaning it's this is not good, guys. And it's been declining too for the last couple of quarters as well. And that is something that another YouTuber pointed out. I probably wouldn't have gone back and looked at this number. I knew it was below industry average, but I wouldn't have known that it had been declining for the last couple of quarters. But quarterly revenue grew year over year by 26%. Really harmed by the growth in government services, really helped by, of course, the growth in private sector. Short of the 30% revenue growth that they want year over year. And Alex Karp on the call basically admitted that it's not going to happen this year. And he kind of didn't explicitly state that it wasn't going to happen. And guys, the phone call was actually painful when they got to the question and answer sector. I thought that the questions were handled really poorly and that Alex Karp went on a rant that maybe similar to some of the rants that I go on here, where it's wildly disconnected and illogical and maybe not comprehensible. But I am not the CEO of a several billion-dollar corporation like he is. I'm just some random dude on YouTube. But yeah, so I think that pay close attention to Palantir as far as the business goes. Start valuing it more like a regular government contractor at this point, and keep an eye on it. Like I said, I've liked the future of this company for some time. I've been less excited about it than most YouTubers are, just because I understand the limitations on the government side. Been more excited about adoption in the private sector. But Alex Karp is dead wrong when he says he has no competition. There's competition everywhere out there. This is just a very difficult business for a lot of people to understand, and they're not really taking the time to see that everyone else is developing similar products at this point. So Mark says, regarding Nvidia, I wonder if it could fall further. Its PDE is 40% even before they reduce their estimates. So typically it stays well above where it normally should be in terms of price, or based on its PDE ratio. That would be historically about average for them, but could it fall lower? Man, I didn't think it would fall close to 150. Somebody else made that prediction on my channel back in January or February. Somebody used to be on here all the time and made a bunch of negative comments, but I did pay attention, and that kind of stuck with me. I thought he was wrong at the time. He was correct, though. It went down to like 155 a share, and ended up picking up a few shares, like 158 or something. But it is this stock is just enormously volatile, and I can't guarantee you, but if you buy this stock and you're not in it for the long run, meaning if you're not willing to hold it for 4 or 5 years, looking really at 10 years, it's going to be very hard to make money based on how volatile it is, or very hard to be satisfied with your return based on how volatile it is. And if you're selling covered calls on the stock, good luck. Because it's so volatile that every time I've tried to do that, even selling at a beta, at a delta of like 0.15 or something, there's been several times where I've had to like either sell the stock or unwind the trade at a loss. Nvidia has been a challenge to create an option strategy around. And because I've kind of gotten burned here as far as when I wanted to get out of it, it may be a better idea in the future too, when I hit a nice valuation in terms of my target, to start creating options collars around that. If you guys haven't checked out my options collar video that I did this morning, which is the put spread collar, I realize that is a super specific strategy for someone who's really concerned that everything we're going through right now is a dead cat bounce, and that all the returns we have had lately are going to evaporate with another like double dip market crash or something, which is entirely possible. Like, I'm not saying that it's not possible, but I'm saying if you're concerned with that, then you want to check out that video that I did this morning on the put spread collar, which is a way to use puts and to reduce the cost to almost nothing, where the bottom line is you get a target exit price that is very near whatever top price that you're considering is right now, and you get to reduce the cost of it. Because if you had 100 shares of Tesla right now, and you tried to buy a near the money put on that, it would cost you somewhere around $8,000 or $9,000. So the put spread collar allows you to create a series of other option purchases around that that create a range of values at which you're going to be able to dispose of that stock or be forced to dispose of that stock. But it preserves your gains, and it actually vastly reduces the cost of that hedging. So, yeah. Let me see here. Michael Will said, you stated fuel prices wouldn't drop until 31.08 because of the futures market. Just say you're correct. Diesel prices were $2 a few weeks ago and are now $1.83. So fuel prices started to drop a little bit sooner than that here. And like I said, it's mostly about futures trading and summer travel season to a degree, and of course, political instability. So right now, futures market looks like almost too good, right? It's almost like no one's planning for a super active hurricane season, which meteorologists are actually planning for. And if you don't know where our refining facilities are in the United States, they're pretty much all along the Gulf of Mexico. I mean, of course, there's some in California, there's some on the East Coast as well, but the vast majority of our refining facilities are located in the Gulf of Mexico. So, yeah. So I'm going to go on here regarding Palantir. Given your experience in the defense government industry, is it true that government yes, it can be, but that was more true about government revenue being lumpy before the advent of software as a service. And with software as a service, that has, especially when it comes to the government, now they're paying subscription fees rather than paying for products all at once. And they didn't used to want to do this, but now they're happy to do this because it allows them to plan out their budgets for years in the future. I'm talking about government agencies. So that has started to smooth out. And Palantir's latest product offerings are really service offerings, and it's going to smooth out their revenues quite a bit. So, and they're not the only ones that are doing this. There's a lot of companies that are doing this here. So, when it comes to their commercial businesses, the total customer count grew. This may not solely be their commercial customers, though. This might actually be their government customers as well. They don't break this down. But they added 27 net new customers in Q2 of 2022, with total customers up 10% quarter over quarter. Once again, these numbers are declining, right? These numbers are declining. And to a degree, I kind of expected that on the government end. On the private sector end, I expect that to pick up a little bit here. So customer count also is kind of flattening in this case. It's not really growing a huge amount. So in the average revenue per top 20 customers, so their top 20 customers account for 17% of their revenue. So I'm used to this working in financial services. Your top 20% of your clients earn 80% of your income. So you better kiss their butts, right? In the software business, though, they would want to be a lot more diversified than this for a variety of different reasons. So what I'm comfortable with in my industry is probably not what they're comfortable with in their industry. I'd have to look this up. I'm not sure this is out of the ordinary for their industry, especially when you work with such large clients. But I would like to see a bit more diversification in here. So deals closed. The nature, character, and dollar amount for those deals, of course, is not disclosed in any of this, but they're saying it's up 67%. But billings, a number that once again is not clearly defined here. Oh, sorry. Billings is defined as revenue plus the change in contract liabilities for the period presented. It's only up 5%. That is a concern. Okay, that's a big concern that year over year that number is up by 5%. So I would like to know why that is, and it's not really well explained in this document. And I like documentation. I don't like what's explained over the phone a lot of times. I really like to see it in paper because that's what they've legally committed to and has been reviewed by all of their lawyers and stuff like that. So we ended Q2 2022 with $3.5 billion in total remaining deal value, up 4% year over year. That is not quite remaining performance obligations. That is what is the value that remains on things that they've contractually signed, which is different than performance obligations, which the dollar amount for performance obligations grew 79% year over year to $1.2 billion, while total deal value only grew by 4% year over year. So these numbers are not terrible, but I'm talking overall for the entire document right here, the entire report. They're not terrible. They're extremely mixed. Extremely mixed. And let me see here. All right, I'll get back to Nvidia here in just a moment. I'm going to see if they've uploaded quarterlies here for Palantir. But yeah, adjusted gross margin. So you can look at adjusted gross margin for Snowflake. You could look at it for Splunk. You could look at it for General Dynamics product, whatever it is. It's roughly going to be the same thing. The adjusted gross margin for almost all software as a service companies or divisions is going to be right around 80%. Okay. Let me see here. So Q2 adjusted operating income was 108 million, representing a margin of 23%. So once again, we see declining margins here. All right. And I think that is total U.S. revenue growth, right? And this is really, really weird. So total U.S. revenue growth, on a one-year basis, up 42%. But then they have revenue compound annual growth of 41% since the start of 2019. Why did they go back 2 years to do that, or 3 years to do that? Like 2019, it's really why they chose to illustrate the things they illustrate is the question that I have right now. And the really tight ranges on the revenue that they expect, the guidance they expect through the end of the year, 474 to 475 million, or revenue between 1.9 to 1.902 billion dollars. I don't know how you come up with estimation ranges that tight. I don't know how you do that unless you're planning on like not making any sales for the rest of the year or something like that. I don't like that's really a pessimistic view, or I don't know, maybe it takes that long for a deal to be funded. But it's only August. So but anyway, so that is Palantir right now. Numbers are mixed, not terrible like people are making it sound. Yes, it's a bad quarter, but for the overall business going forward, I'm really encouraged by growth in the commercial sector. But the slowdown in growth in the government sector is entirely what I expected for a company that's almost 20 years old at this point. Okay, and they have a good enough reputation in the defense and intelligence industry, but other folks have a good enough reputation as well. So let me see here. Shoeless Joe says, I'm accumulating Nvidia very slowly as it's the most expensive stock that I own. Any ideas on how long we could have to buy at sub 200 prices? So Nvidia at this point is probably making a transition to where it's going to be driven more by current cash flows than being priced as by future cash flows. I think, I mean, you can quote me on this and I might be wrong, but I think that historically their P/E has actually been a lot higher than 47. And at most times when you wanted to buy, it was going to be higher than 47, at least since about 2017, that time frame, right? So it's been valued as a hyper growth stock for the last 5 years. Prior to that, it really wasn't. I think prior to 2016, 2017, you really didn't have all this performance like you've had in the last couple of years. I think something like 400% performance over the last couple of years. I think it's probably returning back to a time period because they've got so much money going out in terms of development right now, developing the data centers, developing their medical programs, developing a lot of their AI stuff, their genomic stuff, particularly their molecular modeling technologies. I think they're probably going to folks are going to start looking at them more based on current cash flows. It may stay under 200 or like dip back below 200 for quite some time before we see those levels at $300-$400 a share again. So yeah, but no, Mark asked the question, could it fall even further? Yes, I think it could. I think the bottom for this stock is probably about 100, barring of course, something major happening with the economy as a whole. The bottom for the stock is probably around $150 a share. So, yeah, so very interesting. Somebody at, was it Morgan Stanley or JP Morgan put out a list of the top 10 reasons why you should be more excited about the economy than what was the actual headline? Top 10 reasons to be bullish on stocks right now, according to JP Morgan. And let me be clear, this is not according to JP Morgan. This is according to one analyst at JP Morgan. Okay. He states that valuations appear to be attractive, both in absolute terms and compared to fixed income. That is true. There are, and it's not every stock, but there are a lot of well-known big S&P 500 stocks that are looking stupidly attractive right now, that look like they represent deep value. there's a lot of off S&P 500 financial stocks in particular that look like they represent super value right now, especially if you're looking for stocks that are supported by dividend, which in an inflationary environment, stocks that pay dividends tend to do fairly well, even if it's not a large dividend, even if it's like a 2% dividend. The fact that they're paying anything on their stock, and if they have a history of dividend raises, that stock tends to do really well. So, and interestingly enough, stocks that hoard cash based on research actually perform less well than stocks that pay out higher dividends. And for years, I was convinced that the opposite was true, but there have actually been a number of research studies that show that once stocks start to really hoard cash and they don't have anywhere to put it, something happens to those companies and the stock tends to perform a little bit less. They tend to be a little bit less innovative. They tend to be a little more, unwilling to take risk and that sort of thing. So so valuations appear attractive, balance sheets appear attractive. There are elevated cash levels among institutional investors as well, and an appetite to begin putting funds to work. So a lot of these funds are depending on the direction the Fed goes, a lot of them probably won't end up going into the stock market. It's going to end up going into the bond market. We just came off the worst year in bonds in history. There's got to be people kind of looking at the bond market right now saying some of this looks pretty good, depending on yield to maturity and your time frame. So 3, investor sentiment is currently too bearish, often viewed as a bullish indicator for stocks. I think that would be true. Based on what I saw a couple of weeks ago, bearish sentiment may have peaked about 2 weeks ago. This is a statement that I don't agree with. Federal Reserve hawkishness has likely peaked. I don't think that. I think that the market probably priced in correctly these first 2 75 basis point interest rates. I don't think they're prepared for the next interest rate, which is likely to be another 75 basis points. We'll know, and especially based on last week's employment numbers where we had blowout 500,000 jobs creation. The unemployment rate is dropping to 3.5%, which is unheard of, folks. We are in an era where that is part of what's fueling the sort of spiral here. So U.S. hawkishness has likely peaked. Or Federal Reserve hawkishness is likely peaked. I don't think so. I think we see a further 75 basis points at the next meeting. I think it's even possible we have one at the meeting after that. And then at that point, I think the hawkishness would probably peak because we would fully be in recession at that point. The U.S. dollar has likely peaked for the year. I do not believe that is the case, largely because the U.S. dollar has defied expectations now in the last several crises that we've had. It's not that we're so good. It's not that the U.S. dollar is so good. It's that everyone else is so terrible. China is looking to have serious problems in their economy right now because of there's a sort of a cascading effect in their banking system right now that's occurring. It could happen in any banking system that uses like fractional reserve banking. But the government is going to have to step in and rescue a bunch of banks in China here pretty soon. That's going to put pressure on their currency. A lot of other countries in the world use the United States currency as, I'm talking about individuals use it to save their money in. And that's only increasing anytime we have periods of uncertainty. It's not because the U.S. is so awesome. It's because we don't suck as bad as the rest of people do when it comes to currency controls. I know that's really strange to think, but it's actually true. So I don't think that these number 4 and number 5 are actually true on this list. This is what he's listing. And the economic slowdown is not showing signs of a nasty recession. It really isn't. It's showing signs of a shallow recession, if that at all. Once it's corrected for inflation, I think it's going to show that the slowdown in terms of real spending is a little bit greater than people think. But when you're looking at just revenues, it barely looks like we're in an inflationary environment. So higher income consumers remain resilient. That is absolutely true. That's all the evidence points to that. Even lower income consumers demand seems to be resilient at this point. And earnings estimates on Wall Street are unlikely to be marked down aggressively. Actually, this is an important point to make. I think that the early markdowns on Wall Street were actually too aggressive. And this is one of the reasons we have everyone seeming to beat earnings for the second quarter. They're beating earnings on the second quarter that were reduced after first quarter earnings. So I do think that it's not quite as positive as everyone thinks it is. But I think it's also true that they're unlikely to be marked down aggressively, meaning that people are probably at this point saying the economy is not as bad as we think, right? So this is actually true and something people don't realize. And the economy is not as bad as we think. is that excess savings built during the pandemic are still providing a cushion to consumer spending. That's actually true. Household finances, in terms of household net worth, have never looked better in the United States. And I think that is one of the things that's out there. And there's the growing body of people that think that excess savings built up during the pandemic needs to be spent. I am not one of those people, but there's a growing body of folks out there who think that. I'm not going to get into that right now. And number 10, the global economy is unlikely to see a synchronized downturn. I think a lot of that has to do with energy prices, to be honest with you. There's a lot of fragile economies that are out there. We're about to see I think we've seen one or two defaults right now in emerging market debt. I think that's likely to increase. Yeah. Let's see here. Shoeless just says, why Berkshire Hathaway has an outsized position in Apple. To be honest with you, Apple fits the bill in terms of what Berkshire Hathaway likes. They like to see companies with large amounts of cash on their balance sheet. They like to see a well-managed balance sheet with reasonable amounts of debt. They're not opposed to debt. They just want it to be reasonable. They want a company usually that is paying a dividend, a small dividend, a growing one over time. And they want something that they see as being valued based on future revenues, right? On what they expect as far as like dividend growth and future revenues. And Apple would just fit all those bills at this time. It's not the growth stock that it was in 2005. It now represents a value stock to a degree. And it particularly represents a safe haven in terms of something in the consumer sector if we are going through a downturn at some point. So hold on. Let me see here. Any thoughts on buying puts on Getty? Interesting. I would not have thought of buying puts on Getty. This is not a stock that I hold. This is I'm very interested. I would need to know kind of what your acquisition cost was on that, and I would need to know what your acquisition cost on that, what your target is as far as getting out, how long you wanted to hold these, and we need to take a look at sort of the options chain to figure out how old this is. But this is a stock that has an average volume of about 1 million shares per day. Today, it was only 233,000. PE ratio of 213. Earnings per share of 12 cents per share. So very, very interesting. I don't really know a ton about this company. They had kind of rocky revenues growth over the last couple of years. Of course, this is 2020, so I'm not kind of surprised. Interesting. I think they mostly make their money just by licensing images and audio and video. So, yeah. Yeah, I don't really have an opinion on that. This is not a company that I've ever really looked at. I am kind of surprised here at today's run-up, kind of figure out what's going on. I guess they're reporting earnings pretty soon. But no, this is just not a company that I'm all that familiar with here. So Rad Cha says, it seems in Q2 there are two classes of tech companies dominant: Microsoft, Google, Apple performing well versus laggers, Palantir, Snap, and Datadog struggling. Do you agree? Yeah, but I agree based on this metric. Two classes dominant. No, what you're really looking at is companies that are currently profitable and companies that are profitable in the future. So, and that's the thing, is people have gone back to evaluating companies based on current cash flows. This is a reason why Microsoft, Google, and Apple look so good right now and they're performing so well. We're looking at Palantir, where they're not looking at turning a profit until 2025. You're looking at Snap, which, as far as I know, has never pulled a profit. I don't know. I'd have to look that up. But they're also a company that has struggled for profitability. And Datadog also is a company that I don't think has ever been profitable. And they're still looking to. And that's not to say that any one of these are bad investments. It's just that it's become a lot more difficult to value future cash flows in a rising interest rate environment, especially when we may be looking at a downturn in the economy. So Snap is a stock that I have never held. I've always been a little bit concerned about how well they're really going to be able to monetize their business. And this is one of my concerns with all social media, is how do you monetize? Like, how will the ads fit into your business here? And what I'm not getting is any information on. Oh, here we go. Yeah, Snap has never been profitable. I didn't think they were. They do. It is encouraging that in 2021, revenues rose significantly in 2021, and we get a significant narrowing of loss. But this is not a company that I typically pay attention to. They missed estimates in the last 2 quarters. After the previous 2 quarters, they really beat them. So it was a pretty narrow miss, just a penny last quarter and just a penny the quarter before that. So these are super narrow misses. So I think you want to take a look at that. They may not look as bad as you think. So, but in terms of Datadog, Datadog is a company that I have actually had an issue with why people like this company so much. There's nothing wrong with it as a business, but I have not been able to understand the almost the near hysteria behind this company at one point. Right, 52-week range. This was a $200 stock, just a year ago. It's been down about $81 a share. They recovered. Earnings per share is essentially zero at this point, so they may have been profitable at one point. I wouldn't pay attention to the PE ratio because it's this number right here that's throwing everything off. So, but the beta 1.15, it's only slightly more for a software company. It's only slightly more elevated than the general market itself. So they've beaten revenues every quarter for the last 4 quarters. Highly encouraging. Once again, never made a profit, but their losses are fairly narrow at this point. On revenue of $1 billion, they have losses of $20 million. I would need to know more about their business. They provide monitoring analytics platform for developers, information technology team business use. So, and once again, this is in part going to be a competitor to Palantir, right? Not in every area, but at least with one sector of something Palantir does, Datadog is going to compete. Let me see here. Never purchased Datadog Okta, but so I would be very curious to see earnings. But like I said, Microsoft, Google, Apple, all profitable companies, all profitable for years. Palantir, Snap, Datadog, none of these are profitable companies. You want to say that these are dominant versus laggards, it's companies that have current cash flow versus companies that don't, right? So let's look at Okta. This is something I've looked at in the last couple of cases too. So I'm happy to buy companies that have never made a profit before, especially when I understand their business really well. I think they've got a real path towards profitability. I'm willing to take some risks to do that. But there are a lot of software companies that I refuse to do that with. I'm not saying that that Okta is one of these, but yeah. Do you see NEO having a comeback in stock price for this year? Chris, the answer to that is no. But most of it has to do with geopolitical reasons and macroeconomic reasons rather than company-specific reasons. Now, I kind of made an announcement a couple of live streams ago that I've reevaluated my whole China strategy, and I priced my call options to get me out of NEO at some point, and I'm going to concentrate all my risk in XPeng, right? That's not to say that I think that NEO is a much worse company than XPeng. I really don't. I just want to reduce my overall risk and exposure to China because I see a lot of geopolitical risk there. And I see that they may have more economic troubles than we may really be aware of here. So I'm concentrating my risk in one company and sort of drawing back on a bunch of others at this point. And you could do the same thing with NEO and step out of XPeng, and your logic could be equally as valid as mine. So let's look at Okta here. Once again, no profits in the last 4 years. Revenue beats, but revenue estimates are all over the place here. Main recommendation, of course, is going to be a buy or a strong buy. Very few holds, no underperforms or sells. We're looking at this company providing identity verification solutions for enterprises, small and medium-sized businesses, universities, nonprofits, basically a suite of products and services such as Universal Directory, a cloud-based system to record, store, and secure user application and device profiles for organizations. This is a single sign-on that allows users to access applications in the cloud or on premises from various devices, right? This is a cybersecurity company, an identity verification company. Not going to get overly excited about them until I really sort of get into their business. This is a company that I've followed for a while. It's a relatively well capitalized company. They have a good reputation in the market. It's not one that I've been invested in for quite some time. So I'm really choosing when it comes to investing in software companies, because usually they don't have a sort of like patentable advance over anyone else in a lot of ways. And choosing the winner is usually a lot harder in different industries. So I'm a little bit more cautious. I'm very cautious when it comes to like investing in biotech stuff and genomic stuff. I'm very cautious when it comes to investing in the software sector like this, especially in things where it's harder to grasp what the size of their actual market or what their product is. So, yeah, do you see any investment opportunity from the strangely named Inflation Reduction Act of 2022? Yeah, I did think that it was a strangely named act as well. I really did. Really odd. It's actually, if you're an investor, if you use medical care, it's actually really good for you. If you're an investor in the medical industry, it is not the greatest bill that's been passed. However, if you're an investor in green energies, it looks like it's going to be a pretty good investment here. In fact, that was one of the things that was on the front page of Barron's here that we can take a look at, Michael. And let me see when this pulls up. Yep. So, yeah, why it was called the Inflation Reduction Act, when a lot of its limitations on what you can charge in the medical field, a lot of it is a climate bill. Really, really interesting. So, the climate and tax package passed by the Senate on the money will unlock some of the $370 billion in funding for clean energy and accelerate a historic shift on how the world is powered. Along with a parallel initiative in Europe, the bill could trigger private investments that reach into the trillions. I don't know if it's going to be private investments that reach into the trillions, but it is going to be a lot of private investments. There's a serious commitment here. What we're really looking at here is this shift right here, where we're seeing a greater investment in wind and solar and a smaller investment in coal. Coal is already on the decline. We're also going to see an increase in natural gas, which it looks like it's going to be natural gas from the United States and from the Middle East, and maybe from the Mediterranean, and certainly not Russian natural gas in the future. I'm actually I mean, this is an unpopular thing to say, but I'm actually a fairly large proponent of nuclear energy. I think that in the long run, it may actually be less concerning than burning coal or oil to generate energy. And I think that it should be a part of any green energy solution. I know it's going to make me really unpopular in some circles, but we're looking at the shift right here, where this increase in wind and solar power is going to provide some opportunity, and the increase in natural gas. Like, that is something we're definitely not going away. We're probably looking at a greater increase in liquid natural gas, which means that's probably not going to be done by pipelines being laid across the Atlantic Ocean from the United States. It's going to be done by liquid natural gas tankers, which is also going to be a boon for the shipping industry as well. So definitely something to keep an eye on there. So but mandates in the European Union and legislation in the U.S. are going to be a big accelerant to that growth. Folks expect about $369 billion in government incentives alone to unlock $1.2 trillion in total investment by 2035. The $369 billion in incentives alone is generally going to be in the form of fee and tax breaks, right? So the big winners are few and far between. Green energy indexes and funds often trade based on short-term expectations for government policy instead of long-term opportunity. I think you guys should really focus on long-term opportunity here. And this may be another one of those cases where a broad investment in the adoption of green energies might be more efficient than trying to pick your own winners and losers. I mean, hold a really large basket of these stocks, because a lot of this stuff trades on short-term expectations, right? And a lot of that's going to be hard to predict. Like, long-term value is going to be really hard to predict. So, because some of these technologies are nascent, you just don't have an abundance of publicly traded companies with long-term track records, which is one of the problems we have in the green industry. So, yeah. Let me see. So the U.S. and Europe are now adding about 30 gigawatts a year of new solar and wind capacity, enough to power about 10 million homes. So every year between the United States and Europe, we're adding about 30 gigawatts of power, able to So Cheniere Energy is probably the best liquid natural gas pure play. It's not exactly pure. They have a lot of like gas pipelines that they operate as well. But the Cheniere Energy, which the symbol is LNG, that is going to be probably your best bet for a pure play. Full disclosure, though, I do own shares of this stock. I've owned shares of this stock for it's been a number of years. I don't know if I remember this correctly, but I may have actually received those shares as a spinoff from another larger company, or that may have been like Spectra Energy or something. I don't remember exactly how I got those shares, but yeah, but that is probably your best bet in terms of a pure play, though. Yeah, so this is an enormous amount of new solar and wind that's being added every year in the United States and Europe. Yeah, so the United States had 1.2 terawatts. A terawatt is 1,000 gigawatts of electricity generating capacity by the end of last year. Europe plans to more than triple its wind and solar capacity by 2030. So very interesting. The Inflation Reduction Act, as the climate and tax bill is called, that is very interesting. It is really a climate and tax bill. And some of the criticisms of the bill that I heard were absolutely the most ridiculous thing that I've heard. And it really depended on which news source that you were looking at. So, so project developers claim up to 30% of the value of the project as a credit. In the case of solar and per watt credit for wind, that could take $6,000 off the cost of a standard size $20,000 system. At the same time, investing in solar and wind has long been a tricky proposition. The companies that make the hardware operate on thin margins. That's true, because it's all commoditized. This is not new technology. And the ones that finance it sometimes take on considerable risk for cash flows that can take years to materialize. Yeah, that's actually exactly kind of what happened to the company that did my solar install. They went under for a variety of reasons. Number one, the CEO had a mistress and was spending all the money on her. But number two, the realizing those cash flows was just taking so long for this company. And then when they had the slightest bit of trouble, they ended up collapsing. But that was a company that did mine. So, and inflation, of course, has hurt earnings. Leading wind equipment manufacturer Vestas has lost money and seen its stock fall this year despite booming demand for its products. And I think a lot of this has to do with destructive competition. We are going to see consolidation in this field. So, yeah, let me see here. Somebody asked another question about consolidation. Let me see if I can go back and find this. Hey, Jason, do you see any consolidation in the chip sector, i.e. Nvidia, AMD? Actually, I don't see a ton of like really big M&A deals being done in the chip sector. And a lot of that has to do with like a real strong sense of resistance from almost every nation state involved in chip manufacturing right now. They would see any merger really as being a threat to either competitiveness or a threat to national security. So I don't see any large mergers happening, but I do see consolidation from smaller targets, right? That's probably going to be allowed. But if you look at the ARM and Nvidia merger, that really the SEC and I think the whatever European Commission is over there, British Commission that is over there, they were really uncomfortable with that merger because it would have created too much dominance in one sector, a lack of competition, and honestly, yeah, I think we need actually more competition in the sector, not less, right? And the problem here is the massive investment that it takes to get a company like this off the ground. And the last company to do it successfully, like the last chip company that I can think of really to be created successfully in the United States was in fact Nvidia. At one point they had 90 different competitors that were GPU makers. All of these other GPU makers said, hey, there's not enough money in video gaming. We need to expand outside of GPU. And they all went out of business. Like they had 90 companies were founded pretty much in that same time period. All these companies either went out of business or they were acquired for pennies on the dollar. And Nvidia was the only survivor in that time period, right? All the other companies that competed against were much older. And so, no, I do see smaller companies being snapped up right now, but the larger companies are still going to be there for the two reasons. Number one, geopolitically, it's going to be very difficult for any of these multinationals to merge for production reasons and, of course, national security reasons. So, yeah. Michael Will says NextEra Energy has fared well on the news, and yeah, let's take a look at that for just a moment. And there was one other program that I wanted to use to actually like take a look at stocks and things like that. And I actually got an email from the company when I did it on a live stream a few months ago, and they said, "Don't use our software on your live stream." They sent me a little nasty, Graham. So I stopped doing that. I need to find something better than Yahoo Finance. It just doesn't have all of the information that I want on there. So heavily traded in terms of volume, about 700 million shares or 9 million shares changing hands per day. Earnings per share is positive, pays a dividend of right around 2%. See price to earnings ratio about 67. So it's not cheap in terms of energy stock right now. Beta is fairly low. You see, is that on a 5-year basis? Beta is actually fairly low. It's had steady growth over the last 5 years as well, with a few hiccups here and there. Let me see what they are. Hold on. Earnings beats for the last 4 quarters. Declining revenues, but for natural gas, honestly, that's not all that surprising. 2018, 2019, 2020, if they're really highly concentrated in natural gas, then they may have had declining revenues in that time period. Of course, 2021 going up, and 2022 we're going to see a big increase here. So through activities, it generates, transmits, and distributes and sells electric power to so it's not actually, so it generates electricity through wind, solar, nuclear, coal, and natural gas facilities. So I misunderstood what this company did. I thought they were a natural gas producer. They're actually an electricity producer, and a lot of battery storage products, clean energy solutions, that sort of thing. So this is probably a company that I should investigate a little bit further. It looks like they've been around for quite some time, though. Yeah, this is a company that's been around for a very, very long time, but they've been on a nice exponential upward swing since March of 2009. So very, very interesting. Very interesting. So Next Era Energy. Very interesting. Okay. Yeah, this is a company I'll take a closer look at whenever I get a chance. Hal says you need to take a look at Australian liquid natural gas stocks. We are the biggest exporter in the world and pay good. Are you really the biggest exporter in the world? Don't make me Google that. So I don't know if you are or not. Actually, that's and it could be true. I think though that one of the other things that's a temporary opportunity that could be a really, really good one though is to look at shipbuilders and people that specialize in building. So I don't know if you're old enough to remember the sort of explosion in dry goods shipping stocks that happened prior to 2008, where these guys were paying like 15% dividends. Their stocks were going through the roof. And of course, it all crashed in 2008 when global trade came to a halt, essentially. But I think there may be a similar boom coming for liquid natural gas shippers and tankers. There really aren't that many of those tankers all around the world, and more of them are going to need to be built. And I think there's going to be less reliance on the pipelines coming out of Russia. I think that even some of the former Russia or Soviet republics that have been reliant on Russian pipelines to ship, I think that is even going to change as well. And we're going to need a lot more in the way of liquid natural gas tankers. Could be an opportunity there with shipbuilders. I don't know. A lot of people got burned on the dry goods shipping boom that happened prior to 2008. So Shopify, Meta, Alphabet, and Stripe are investing in carbon capture technology. Do you think there's a future in it? People have been talking about the future of carbon capture technology at least since the late 1990s. I thought it was really, really interesting a few years ago. I've fallen less in love with it over time, just because I don't like the fact that it really only exists because of government mandate. There's a lot of industries that only exist like that, but that's one of the things I don't really like. But I'm trying to be fair in my investigation of this. I'll come out with a more informed opinion at some point on that. But at this point right now, I don't have any investments in carbon capture technology. I think the best investment in carbon capture technology is actually probably electric vehicles, rather than having distributed production of free CO2 through internal combustion engines. You're going to have CO2 being produced at facilities where concentrating and containing those emissions is going to be a lot safer to do, or a lot easier to do, not just safer, rather, but a lot easier to do it's easier to capture carbon at a central power plant and then use transmission lines to get the electricity to your house than it is to capture carbon that comes out of your internal combustion engine. So I think that is probably the best investment. There are other technologies though that I'm just not taking a look at this point. I will. So, how much potential does Impinj have? Man, I covered Impinj last year in a video, and I talked about some of the applications that I thought they could have in the future, as far as connecting objects to the internet without having them be on Wi-Fi and that sort of thing. So I thought the potential was huge there, but it wasn't clear at the time, especially with Amazon sort of moving away from using the Impinj or Impinj-like technology for warehouse management. I became a lot less hopeful about the future of Impinj here. But I do know that they've moved a little bit in terms of their stock price. I'll be taking a closer look at them in the future. I did do a video on them. It may have been even 2 years ago I did that video. So Russia, Ukraine has mostly dropped out of the news in the UK. Is there any meaningful update? So right now, progress in the war can really be measured in meters. It is turned into a stalemate. So, yeah, it's really turned into a stalemate there. What is likely to happen is we're going to see as we advance into fall, we're going to see everything grind to a halt as we see another mud season. And then when the ground freezes, I think that's when we see a break in the action. I think somebody breaks in the wintertime this year. And I don't want to, I think you guys know who I think breaks and who I think wins. But I think that in the wintertime, that's really going to show us just how this war is going to go. Once tanks are able to move freely again, there's not any cover because everything's lost their leaves and the ground is frozen. We're going to see a much different looking war. Okay. So Mark Butler says, Impinj is killing it right now. I'm up 37%. Shame I only have 3 shares. Yeah, it is. And in fact, I have no shares. I did that video on Impinj like 2 years ago, never ended up actually purchasing those shares. And so let me see here. Let's take a look at that at Impinj. Yeah, it's pretty far up. So 52-week range, it hit a bottom of about $39 a share, and now it's back up to really close to its 52-week range. I think when I originally did my video on that, it would have been at $73 a share or something like that. So if I had bought then, I'd be up, but not by a whole ton. I really wish I had grabbed some at $39 a share, although I'd still be sitting on it. I'm not one of those people that sells. So earnings beats the last 4 quarters. However, they've never been profitable as far as I know. They don't tend to have narrowing losses. They do have increasing revenues. But let's put this in perspective, though. Revenues at $190 million. This isn't a huge company. It's not a small one, but it's not a huge company here. Mean recommendation is probably a buy or a strong buy. Very few holds, no underperforms or sells. And just as a reminder, they operate cloud connectivity platform in the United States, which basically it doesn't use chips or putting people on Wi-Fi. It uses a different technology. So wirelessly connects individual items and delivers data about the connected items to business and consumer applications. And it basically does this by using like radio producing crystals. So very interesting. Nice. It says, I bought Impinj after listening to your video. It's at 2x now, plenty to hold. So thanks for that video. Wow, that was the last video I made on that, and on that company. And when I made it, nobody liked that video, and almost nobody watched it. And to be honest with you, it's a hard company for a lot of people to understand, and especially who wants to talk about inventory management by using things that are scanned by like with remote sensing. Like, who really wants to talk about that? Who really wants to consider it? It's actually pretty huge, though, in terms of everything it could be doing to connect objects that are in transit to the internet without having them like be like actually connected to the internet. So they're basically using things that are similar to well, I don't want to say they're similar to Apple's AirTag, but they kind of function in a way like Apple's AirTag, but in a very different manner. But it was just a company that I was not able to express kind of how exciting that technology was in a video. And it showed in the video and it didn't get a lot of views or anything. And I didn't do a follow-up on that because of it. I'm happy to talk about it, though. This is a company that I think does have a pretty big future to it. And I read all of the articles at the time that were kind of on the other side of that argument. But the reality is their revenues have only grown since that time period. their customer base has only grown since that time period. Yeah. So, and this is on a list of best momentum stocks to buy for August 4th. By the time something appears on the best momentum stock on there, it may be too late to do that. But I'm happy that you got a 2x on that. So thank you so much, Vinnett. And Mark, I'm happy that you're way up on that too. Yeah. So we're actually over an hour, and I want to limit myself to an hour a day on these for the time being. I do have my kids are starting to trickle back into town now after being out of town all summer. And wife is coming back in town as well. So I'm starting to get super busy. So I'm going to limit these to like an hour a day. Wanted to thank everyone for coming on today, and wanted to basically say I'll be back on tomorrow if possible. Playing single dad here for the next couple of weeks. Not for real. We're just, yeah. But anyway, happy to talk to you guys tomorrow. I'll try to put out some more videos. The video I put out today was very, very specific to when it comes to options, which is, hey man, you think everything's a dead cat bounce right now? You think we're in a sort of a bear market trap right now? You may want to consider that put spread option strategy. It's a way to hedge your positions on your stocks and to vastly reduce the cost of it. You do trade away some of your upside potential, but a lot of times you could still leave room for a 10 to 15% run on the upside for any stock that you have, while protecting almost 100% of your downside risk. But yeah, so I will see you guys tomorrow, and you have a nice day.